Hey, welcome back to the Junius Maltby Channel. Let's take a look at the dollar, the leper with the most fingers left. Lately, it's been down. We've been seeing it drop, and of course, yesterday I had mentioned it, but I didn't look, and it was indeed below 90. It was at 89 and change basis points. Metals have both been rising against the declining dollar. Gold up, again, getting close to that 1900 mark at 1892. Silver finally above the 28 mark. And remember, I'll keep reminding you this, we were told that gold would not see 1900 again. I think they're wrong. And there's a good read today. I'm going to go through this because it's the one piece that I do want to cover because it ties all of this in together, both the stimulus, the recent economic events, but specifically it's discussing the dollar. And the title of this article is The Demise of the Dollar, Reserve Currencies in the Era of Going Big. It's by John Plender. This is a good piece. It was out yesterday. And I'm just going to read through it, and we'll discuss some of the points here. Billionaire U.S. fund manager Stanley Druckenmiller delivered an apocalyptic warning earlier this month that the dollar could cease to be the predominant global reserve currency within 15 years. Quote, I can't find any period in history where monetary and fiscal policy were this out of step with the economic circumstances, the chief executive of Duquesne Family Office declared. He is not alone in expressing concerns about excess U.S. demand, a more inflationary environment, and accompanying dollar weakness. Such worries have been a contributory factor in the jittery equity markets of the last 2 weeks. The dollar has survived at least 4 decades worth of predictions of its demise. Yes, of course, barely. It's barely surviving. Yet Druckenmiller's views on currencies should not be cavalierly dismissed. This is the man, after all, who with George Soros, quote, broke the Bank of England when he made a hugely profitable bet back in 1992 on sterling, leaving the European exchange rate mechanism. Druckenmiller's warning comes against the background of a long-standing retreat from the dollar as the world has moved gradually towards a multiple reserve currency system. Even before the pandemic and the extraordinary economic conditions it has generated, there were signs that the dollar's dominance was slipping. The IMF's latest survey of official foreign exchange reserves shows that the share of U.S. dollar reserves held by central banks fell to 59% during the fourth quarter of 2020. It's the lowest level in 25 years. This compares with a share of 71% when the euro was launched in 1999. That protracted trend is logical, as Barry Eichengreen of University of California, Berkeley has long argued. The U.S. accounted for the majority of the industrial production of the non-Soviet world after the Second World War. It thus made sense that the dollar was the principal unit in which exporters and importers invoiced and settled their trade, in which international loans were extended, and in which central banks held their reserves. It's pretty obvious that this paradigm is shifting, and I think you guys have seen this for years. This is something we've been talking about. We've been watching this kind of in real time, but slow. The real time is slow. This move away and out of dollars. Now let's continue. Today, with the U.S. accounting for less than a quarter of global gross domestic product, it makes less sense and leads to the accusation leveled by the then French finance minister Giscard d'Estaing in the 1960s of the exorbitant privilege, unquote. He calls it the, quote, exorbitant privilege whereby the U.S. government can borrow more cheaply because of the greater demand for its IOUs arising from the reserve currency role. We've always talked about this exorbitant privilege, this entitlement that the U.S. has with the dollar being the reserve currency, and it's a monopoly, and it is. It's giving away. It's gone. It has to go, and I believe that it's going to, and I think the world wants it to. And again, this is something we've talked about extensively. What do we call it again? We've called it privilege. It is. It's American privilege and entitlement. Another aspect of the exorbitant privilege is that the Federal Reserve, with a mandate geared to purely domestic conditions, sets a monetary policy for the whole world, which for many countries is less than optimal. The latest IMF numbers confirm that the privilege is eroding as countries that trade with and borrow from the euro area increasingly seek to hold euro reserves. See, they want euros, not dollars. That process is now happening with China and the renminbi, yet the erosion has been very gradual. The question then is, are there circumstances which what will still amounts to dollar dominance suddenly could turn into a dollar rout? Yes, I think a dollar rout could happen. I think there are circumstances. The anti-inflationary credibility is at stake. When it comes to reserve currency status, there are huge advantages deriving from incumbency, partly from inertia, but also from network effects. The more people use the dollar, the more useful it is for everyone else. And as Dario Perkins, head of global macroeconomics of T.S. Lombard, points out, the leadership of the global economy does not change hands often. Most previous regime changes, he says, whether in 15th century Venice, Amsterdam in the late 1700s, or the UK in the 1940s, happened because of political turmoil, usually involving devastating military conflicts. That said, there is general agreement that the biggest single peacetime threat to reserve currency status is economic and financial mismanagement. And with the Federal Reserve having abandoned its long-standing commitment to tightening policy in anticipation of inflation, and President Joe Biden, quote, going big with fiscal policy, the fear that inflation could undermine the currency is mounting. We're seeing it every day. It's in the news every day, ladies and gentlemen. Inflation is front and center. It's a major discussion. It's a major risk. It's a major concern. And this fear that inflation could undermine the currency mounting, that is happening. It's in the circles. Those concerns have been most forcefully expressed by former Treasury Secretary and fellow Democrat Larry Summers. We talked about that. We did a video on that. Who has said that the Biden administration is pursuing the least responsible fiscal macroeconomic policy that we have had for the last 40 years. In an interview with FT last month, he declared that when it's explained that the Fed has an entirely new paradigm, it's a bit hard to understand why expectations should remain anchored. He added, "We are seeing an episode that I think differs both quantitatively and qualitatively from anything since Paul Volcker's days at the Fed, and it stands to reason that would lead to significant changes in expectations." In other words, the anti-inflationary credibility won at such high cost by the Fed over the last 40 years may now be in question, causing foreign investors to worry that the U.S. will inflate away the value of their Treasury holdings. You realize what that just said? You realize the gravity of this? That the world could be concerned about the Fed inflating away the value of their Treasury and the dollar? The dollar is teetering, ladies and gentlemen, and everything that's denominated in dollars will be teetering with it. Now, one of the most fundamental requirements of a reserve currency is that it is backed by a state that can provide safe assets to global investors. Now, I would say it would be backed by a liquidity anchor such as gold and silver, but we know that that's not the case anymore. Now, the U.S. has done that for more than 100 years, with the U.S. Treasury market offering the safest haven in the world in times of crisis and the most liquid securities. That is, the easiest to trade. See, that's the thing. That's a lot of the dollar apologists. And you'll hear them. Those that hold up dollars and say that they're great and they're strong and it's the world's safest place to be. And when the markets collapse, everyone turns to dollars and there's treasuries and dollars and they speak highly of them. See, that's shifting. You're falling into a trap there. That past performance is a guarantee of future performance. You see, just because the dollar was the reserve currency, just because the dollar used to be viewed that way, doesn't mean that the future holds that as well. It's changing. People are running from it. They're fleeing from it. It's starting slowly, but soon I believe, Junius Maltby truly believes, it will end up being an eventual stampede away from and out of the dollar. And its collapse will then happen at a rate that is unfathomable for us. The velocity in which it deteriorates will be significant. Because yes, it was liquid, but that's going to change. People won't want it eventually. Yet if the state pursues irresponsible policies, this is important, if the state pursues irresponsible policies, those assets become less safe. That's what's happening. The greatest potential threat to safety, as Summers implies, is inflation, which shrinks the real capital value of fixed interest investments. It also decreases and destroys the purchasing power of that currency. Now, the erosion of safety, the fears about potential inflation are not the only reason some investors are raising new questions about the role of the dollar in the international financial system. The pandemic-induced turbulence in the Treasury market in March of 2020 has raised important questions about the market's liquidity. In early March, the COVID scare sparked a typical orderly flight to safety in U.S. Treasuries, but from March 9th, there was a disorderly flight from Treasury paper into cash. Analysis by the Basel-based Bank for International Settlements has shown that the dash for cash resulted substantially from forced selling by hedge funds that had borrowed heavily to profit from small differences in yield between cash treasuries and the corresponding treasury futures. With the downward lunge in the market, the solvency of these highly leveraged funds was threatened, and their lenders called in their loans, forcing the hedge funds to sell. In effect, a feedback loop developed, in which the inability of dealers to absorb sales led to further price declines, prompting more sales and leading to further price declines. Dealers responded by widening the bid-ask spreads. They offered their clients on average by a factor of 13 in the first weeks of March. That should not have happened in what is usually termed the world's deepest, most liquid government bond market. U.S. Treasury data show that much of this turbulence was internationally driven. Global investors' gross purchases of U.S. Treasury bonds and notes reflected a classic flight to quality, jumping from $1.79 trillion in February 2020 to $2.67 trillion in March. Yet this was more than offset by foreign sales, which jumped from $1.79 trillion to $2.98 trillion, nearly $1 trillion higher than the previous peak over the decade. This erosion of safety was a reflection of structural changes in the Treasury market. Darrell Duffy, a professor of finance at Stanford University Graduate School of Business, has pointed out that while growing federal deficits since the financial crisis of 2008 have caused the stock of marketable treasuries to grow significantly, the balance sheets of the large banks that own the big primary dealers have not kept pace, partly because of tougher capital requirements introduced after the financial crisis. The gap has been filled by shadow banks, such as hedge funds, whose ability and readiness to provide liquidity in a crisis is limited. In the event, the Fed rescued the Treasury market from extreme dysfunctionality by flooding it with liquidity and relaxing bank capital rules. Yet there remains a risk that the Fed's morally hazardous interventions will ensure that bouts of illiquidity arrive with greater frequency and magnitude, given the historically high and growing ratio of federal debt to GDP and the ballooning stock of outstanding Treasury securities relative to the capacity of dealer balance sheets. The other threat to the dollar's reserve currency role is dysfunctional politics. Donald Trump exposed hitherto unsuspected weaknesses in the checks and balances of the U.S. system, with many in the Republican Party questioning the outcome of the election, and the former president having incited the attempted insurrection that they talk about. Of course, they're going to get into that. The quality of the American democracy is in question. And while Biden has moved to restore relations, of course, this is a little bit of, I'm sure, going to be friendly towards him, and return the principle of international cooperation, he is not rowing back strongly from the Trump-era protectionism. These are not good omens for a reserve currency. Yet there is a case to be made for the extraordinary stimulus underway. Yeah, I don't think so. I don't think so at all. In seeking to pursue a more aggressive fiscal policy, than the U.S. adopted after the financial crisis, the Biden administration hopes to facilitate higher growth, which could make for less poisonous domestic politics and provide a more stable underpinning for the dollar. I disagree. There is no hope. There's nothing you can do. You will not save this. You will not resurrect it. The dollar is doomed. But let's continue. Meantime, international capital appears to be giving Biden the benefit of the doubt. Given their security dependence on the U.S., big holders of dollar reserves, such as Japan and South Korea, are unlikely to dump the dollar. Oh, but they could. As for China, U.S. Treasury data showed from August of 17 to October 20, China's holdings of U.S. Treasury securities declined from 1.2 to 1.05 trillion. After Biden's victory, they rose in monthly progression to 1.1. But again, remember, Russia's been dumping theirs as well. Other countries are dumping it. People are dumping the dollar. Now, this despite the new administration continuation of much of Trump's hostile approach to China. Now, alternative gains, if the dollar has retained its hegemonic role thus far, it is because reserve currency status is about relative, not absolute advantages. The question has always been, what are the alternatives? In terms of economic might, the only realistic immediate challengers are the euro and the renminbi. But what about the cryptosphere? That's me adding that part. I wonder about that. I believe there are moves taking place that look like that they're going to kind of offer that as a solution at some point. I don't think they're telling us everything here either. But other currencies like the euro and the renminbi both are gaining, albeit slowly. They are gaining in relative advantage. Now, the chief difficulty with the euro has always been the lack of a government bond market capable of providing safe assets on a scale comparable to the U.S. Yet the response to the pandemic has finally pushed the bloc into moves to create a European Union recovery fund, financed by commonly issued EU debt. Well, that doesn't sound like that could end well at all. These moves are as yet tentative, but they suggest that the euro, currently making up 20% of global reserves, could play an increasing role. Now, in the case of the renminbi, Beijing is committed to challenging the dollar and has actively encouraged the use of the renminbi in bilateral trade transactions. The Belt and Road Initiative provides new financing opportunities for the digital renminbi currently under development. And Beijing has the advantage that China has recovered more strongly than the other big economies from the pandemic. Foreign capital has been flooding in, too, as China has progressively opened its financial markets. David Marsh, chair of the OMFIF, the central banking think tank, said that the People's Bank of China has recognized that the renminbi appreciation will help control inflation as well as foster a shift of focus away from external and domestic demand. A stronger renminbi will thus help the currency's internationalization because foreign investors will be rewarded. Investors nonetheless have to include Chinese authoritarianism and a tradition of active state interventionism in markets in their calculations. Now, the wild card in this debate relates to digital currencies. As I mentioned earlier, Bitcoin, which moves several percentage points on a single tweet from Tesla chief executive Elon Musk, lacks credibility as a potential reserve currency. But Mark Carney, while governor of the Bank of England, suggested in 2019 that technology has the potential to disrupt the network externalities, the benefits of using a currency that many others are using that prevent the incumbent global reserve currency from being displaced. I still think that a global blockchain type thing is going to somehow find its way into this. It just looks like it's ripe, as if it's perfect. The circumstances of all of this seem like it's almost as if they want us to ask for it, if you know what I'm saying. It's like they're trying to create an environment in which they have this hidden solution. I don't know, that's just me thinking. He speculated that a new synthetic hegemonic currency could be provided through a network of digital currencies issued by central banks. Think of that. Think of all the talk we've had on CBDCs, central bank digital currencies, and incorporate this article into that thought process. This would enable spillovers from shocks in the U.S. through exchange rates and trade to become less synchronized across countries, while the dollar's influence over global financial conditions might likewise decline. Many are skeptical The Geeta Gopinath, a IMF chief economist, believes that technology has plenty to offer in providing cheaper and faster cross-border payments and improving financial inclusion, but her view of the development of the international reserve system focuses more on old-fashioned development of institutions to improve their Eurozone's architecture and resilience, and stronger domestic institutions and further liberalization of markets in China. I think she's wrong. I think she's kind of stuck in the archaic old ways and also, who knows if she's being paid to think this way or whatever, but she sounds to me, from what I've read, the little bit that I know, that she's almost like an apologist for the status quo, for the system that exists currently with dollar hegemony. I don't know. History tells us that it took just 10 years for the dollar to remove sterling from its reserve currency role. That reflected the devastation wrought on British economic and financial might by the First World War. In the light of the extraordinary fiscal and monetary response to the pandemic, it seems unlikely that the pandemic will prove as economically potent as that military conflagration. I don't know. It sounds like they brag about the fact that they've spent more, that more money has been spent and created than in the world wars. So why would it be any different? But let's finish off. The last sentence says, but the threats to the dollar to watch are U.S. fiscal profligacy and monetary debasement. Monetary debasement. Now, I know for a fact that that's happening. You know for a fact that it's happening. And I truly believe that articles like this are just the tip of the iceberg. It's almost as if they're letting the secret out of the bag already. It's kind of a clue that the demise of the dollar, that its reserve status is ending. It is waning. It's the end of an era. And the 50-year anniversary approaches of the breakdown of Bretton Woods and the unbacked trash paper fiat dollar dominating the world scene. It does look like it is coming to an end, though. That's it for today's discussion. Join the comments down below. Thanks for all my supporters, Patreon members, channel members, all of you. Thanks for being part of this channel. Take care. Have a good rest of your day.